This is going to be a discussion of some more advanced option strategies. We're going to talk about covered calls, which involves selling calls against shares that you already own. We'll talk about protective puts, which involves buying puts on shares you already own. We'll talk about money spreads, which involves trading in two or more options at the same underlying security and same time to expiration, but with different strikes. Bull spreads, a type of money spread in which you're bullish on the underlying security, and bear spreads, where instead you're expecting that security to fall. And then finally, we'll talk about two types of volatility spreads. One called a butterfly spread, which involves both buying and selling options, 4 of them, and is a way to expect or to profit from an expectation of the underlying security staying within a certain range between now and expiration. And then finally, we'll talk about straddles. That's where you trade both a call and a put at the same strike in order to profit on changes in expectations regarding volatility or risk of the stock. So these up here are sort of directional bets, strategies to trade on the direction of where you think the stock is going to go. And then these down here are bets not about the direction, but about the volatility of the stock. With these ones, you make money regardless of whether the stock goes up or down, but you make money by changes in how much the stock goes up or down. So let's look at each one of these in turn. Starting with a covered call. So a covered call is the simplest of the strategies that we're looking at. And it's like you've got a share and you've got 100 shares, and maybe you want to hold on to those shares because they'll increase in value, or but while you may think they increase in value, you're realistic. You don't expect these shares to go to the moon, so to speak. You expect them to rise, but not by too much. And options, really, people pay for options because they expect a whole range of different outcomes that may occur. So some people buy out-of-the-money calls because they expect the stock price to go way high. And sometimes they overpay. That is relative to the chance that that stock actually goes this high. They're paying too much money to buy calls that pay off in that type of event, and only that type of event. And so if I expect my stock to rise, but not by that much, I expect it to go to here, but not to here, then I can earn a little bit of a profit over and above just holding on to my stock by selling, if I own 100 shares, one call. And it's going to be an out-of-the-money call, meaning I'm selling someone the right to buy from me the shares at a specific strike price. And it's a strike price that's way above the current price. And so, I may not get paid that much, but there might be someone out there that pays me an extra 2% per year for the right to buy the stock if it goes that high. And if it never goes that high, then I still get to keep the 2% and any increase in the stock price as long as it didn't go beyond that strike up here. And so by owning the shares, But then by agreeing to sell a call on those shares, agreeing to sell those shares at a specific strike price, I get much of the upside, and I also get the premium from selling the option. That's mine whether I win or lose. And that is an extra yield on the stock that I otherwise wouldn't have gotten if I had simply held these shares like a normal long-only investor. But the disadvantage, if these are the benefits, then the disadvantage or the risk to this is an opportunity cost. If the stock goes incredibly high, or if it goes beyond the strike price, which is shown here in this range of possible outcomes that the price could exhibit, then the risk is that my gain is capped at anything beyond that strike. Someone bought the right from me to buy this security at the strike price, and if it goes above the strike price, they still get to buy at that price. And so that means I have to sell to them at that strike price. So what happens in that case is that the 100 shares that I owned, that I sold one call on, and one call is worth 100 shares, those shares now get taken and given to the purchaser of my call option. And in exchange, they have the right to buy at that strike price. So in exchange, they'll give me X for every share that I sell them, every of these 100 shares. So in the end, it's a little extra yield, but I'm selling off the upper tail end of potential returns for this stock that I own. And as to whether that's a sensible thing or not, it kind of depends. And basically it depends on how expensive the options are. If you see that for the shares that you own, the implied volatility on out-of-the-money call options has been rising, that means people are paying more and more for those for those call options on those shares than they used to. And oftentimes, when implied volatility is really expensive, is where you want to be doing this type of strategy, because people tend to be in that type of scenario overpaying, paying really strong prices for something with a relatively low probability of occurring. So it makes sense to pursue covered call strategies when implied volatility is really high, rather than when it's relatively low and people aren't, and when you're not getting very good prices for selling the calls. Okay, so let's talk about another strategy in which you own the shares. Again, let's say 100 shares. And by the way, all of these strategies, we're using equities as an example, but there are options on a number of different securities besides equities that we can apply these strategies to. It's just easier to comprehend when we're talking about equities. And so 100 shares, the multiplier for equity options is 100 shares. But that's going to be different if we're looking at, say, options on futures contracts or options on commodities. But okay, so if we own 100 shares and maybe we like the stock, we think it may rise, but there's some risk that it could fall in value, and that would be a detrimental impact to our portfolio. So one thing we could do is simply not hold the stock or hold less of it, but another approach that we can do using options is to effectively buy insurance on this 100 position stock that we own. We buy a put, and we buy a put specifically that's out of the money. at the point where we're really concerned about the stock price dropping too. So the strike is out of the money, and if the stock price falls beyond that strike, we no longer lose any additional money because the gain on the put beyond that point offsets the loss in our 100 shares. So if we own these 100 shares and the shares rise in value, then that's fine. The put expires worthless. Of course, we lose our premium, but since the put was out of the money, then hopefully that premium wasn't too expensive. And so if the shares rise in value, then so does our total profit on this 100 share investment, plus including the premium cost of the put. But let's say that our strike price was here for this insurance that we bought. Then if the stock falls in value instead, then that's unfortunate for our 100 shares. But as soon as the stock falls below the value of the strike price, we've locked in our maximum loss, you could say. We no longer lose any more money because at this point right here, the option is starting to pay off. Remember, the difference in the strike minus the spot, or zero, is the value of a put option. And so 1 for 1, any additional fall in the value of the underlying will increase the value of this put option. And the profit on that put option 1 for 1 offsets the losses on our underlying shares. So it's like buying insurance. Money spreads are where you're trading 2 or more options. We'll just look at 2 for now. And it's on the same underlying security and the same time to expiration date for both options. And the only difference is that the 2 options are at different strike prices. Trading spreads across different strikes, you can do it either where you typically buy a call and simultaneously sell a put, or where you sell a call and buy a put. As far as which you choose, it depends on the direction where you think the stock is going to go over this time period. For example, let's take a look at a type of money spread called a bull spread. This is a type of money spread where you are bullish on the underlying, meaning you're expecting the stock to rise in value. And so for that reason, you will go long a call, you'll buy a call at whatever strike you think is appropriate, but then also you'll short a call at a higher strike price. And you can think of it like this, with a call, just one call being bought, then if the underlying ends up going above that call, then you'll start profiting. But at the same time, if you had sold a call up here for a higher strike price, that means you're selling a call. So you're getting the opposite. You're actually losing money if the value of this security goes up and beyond that point. And so beyond this point, this security here is losing money, although this security here, the call that you bought, is still gaining money. And so any time beyond here, the two are offsetting each other. So you don't gain any more money, but you also don't lose any more money either. So this is a bull spread, Because, well, you're bullish because you are buying a call. And so if the value of the security goes up beyond that strike, you will make money. It's just that you sort of cap your maximum profit to the point of this second strike here where you sold the other call. And you might ask why you would do that. And the answer is that by selling a call at the same time you buy one at a lower strike, by doing that, you're lowering the net cost to put on this position. You're lowering your net premium because you pay a premium for buying a call, but then you receive a premium for selling a call. And the premium that you receive is going to be less because it's further out of the money. So you'll still have to pay something, but at least the cost of putting on this position is lower. And if it's lower, that means there's a greater overall chance of you making money because you've lowered your expense. It's like if you expected it to go up in value, but you're like, let's be reasonable. It's not going to go here. The stock is not going to go this high. Then why not sell a call for this range? Because it'll just make your net profit by reducing the cost of total premiums that much better. So if you've got a range of likely expected outcome for the value of this stock, it's actually a way to make your options trading even more profitable. So this is how you use a money spread if you think that the stock price is going to rise in value. But let's take a look at how we would trade if we thought that the stock was going to fall instead. If instead you're expecting the stock price to fall, one thing you can do is a bear spread. And that is where you buy a put, as you would normally do. If you expected something to fall in value, one way to profit on that is by buying a put. And that's at some strike. But at the same time, you also sell a put on the same security and the same expiration date at a lower strike price. So you buy a put at a higher strike price, selling a put at a lower strike price. Both of these are out of the money, meaning they're both of the strike prices are below the current underlying price. But it's just that when the one that you sell is even more out of the money than the one that you buy. And the way it looks is kind of inverse to the bull spread. It's the strike price here for the put that we bought and the strike price here for the put that we sold. And it's sort of like saying we expect it to go down below this strike right here, but we don't expect it to actually fall by that much. And by taking that opinion of range, instead of just buying this put here, we lower our cost outlay. We pay less as a premium because here we sold a put, and so we receive a premium. Here we can offset some of the cost of paying or buying a premium. And what it ends up looking like as far as profit is that if this is the value of the security right now, the underlying value, then as the underlying falls in value, nothing really happens. I mean, sure, both of these will change, but really what's happening is as soon as the underlying falls in value below the strike, this thing starts to profit, and your position will continue to profit. And yet you sold a put here, so if the underlying falls below that, then you're going to lose money on this put that you sold here. This one will lose money, but this one continues to gain money. And so the two offset each other out at this point, which is why you see no change in profit, positive or negative, if the stock continues to fall. And so then here is really your range of profit. Your range of profit is decided by the difference between these two strikes. Anything below this point is where you make money, and anything above this point. And to recap, why would you do this? Why wouldn't you just buy a put? It's that by selling a lower strike put, you're offsetting some of the cost of buying this higher strike put. So it's basically making it cheaper to enter into this position, cheaper to buy a put. And the cost is that you're giving up some potential profit if the stock really drops in value. And so you do kind of have to have a educated opinion about how far you think the stock will realistically fall. That's going to determine the ultimate strike price that you select for where you sell your put. But if you can do it right, you can offset the cost of your premium. That gives you an even greater chance to profit. A butterfly spread is a more complicated strategy because it involves 4 options that you simultaneously buy and sell. 4 options are traded. And the way it plays out is that you'll make a profit if the stock ends up within a specified range. There are 3 strike prices that you transact at. First, on the low end of the range, you buy one call with a low strike price, out of the money. And then at the other end of the range, you buy another call, still out of the money, but at a higher strike price. Let's call it X3. And then the key difference here that distinguishes a butterfly from anything else is that in the middle here, equidistant between the upper and lower calls that you bought, you actually sell 2 calls. They both have the same strike price. And all of these together, they all have the same time to expiration, time to maturity. One benefit is that by buying these calls, but then also selling the calls, is that your premiums somewhat wash out. The costs of buying are offset by the premiums earned from selling. They're not completely offset, but they do lower the cost of entering into a butterfly spread. And so it lowers your maximum loss. And where you kind of end up making money for something like this, I guess you could say that's how it gets its name for a butterfly spread. Because the profit diagram, your peak profit is actually around here at the strike where you sold these 2 calls. And you can actually continue to make money, although less so, if at expiration, the underlying falls anywhere within this yellow range. This is your range of profit. And it's not quite at the strike because you have to consider the cost of the premium here. But the key point of this strategy is that you make money with this butterfly spread if it's somewhere within here. Down here, that's really where it gets its shape. I guess that looks like a butterfly. It kind of looks like a triangle to me, but whatever. The key idea is that at a relatively low cost, you're betting on, or you'll make money as long as the stock stays within a certain range. Calculating the exact profit at expiration is a little bit cumbersome with butterfly spreads. That's because you have to calculate the profit and loss of 4 options together. It does simplify a little bit, though. If we take just this first call here on the bottom, then the profit for that will just be like a normal option. For a call option, it's either 0 or the difference between the value of the underlying and the strike. And then if we take a look at the next 2 options, the next 2 options are the calls that we sold. And so we're opposite in sign of a normal call because we sold it. And then the value of that is that, well, we had 2 calls that we sold, but otherwise it's still the same, either 0, the profit on this, or the loss, in this case, is still going to be the same kind of function, S minus X. This time the strike price being at that X2 level here. And then finally we have one more call option to look at. This one we bought, so it's a plus sign. And we only bought 1. And it's the maximum of either 0 or, again, whatever the underlying is, minus the strike for this one. And so if we take that, that's the, I guess, gross profit, you could say. And then we subtract out the net premiums. We have to consider the fact that we paid for this call option here. So it's a minus. But then we received 2 premiums associated with selling 2 calls at that middle strike price, which was located here. And then finally we bought 1 more call at that high strike price, which was meaning it's going to be the most expensive right here because it wasn't as out of the money. And so the 2 calls we wrote plus the 2 calls we bought, we have to look at the net cost of that. Subtracting out the net premiums gives us our net profit. All right, so the key takeaway about a butterfly spread, lots of things that we don't necessarily need to remember. We just need to know that they're there in terms of how to calculate. But the key takeaway from a butterfly spread is that you're kind of betting on a range of different outcomes. It doesn't cost you very much to put on the position, and you'll profit as long as the underlying is within that range. That's similar to the next and final strategy we're going to look at, called a straddle. And with a straddle, we're trading on the volatility or expected change in risk of a stock. We don't actually care about whether the stock is going to go up or down. I mean, it could go either up or either down, and we'll still make money as long as it goes up or down by a big enough amount. With a long straddle, we are therefore long volatility. And here we buy a call, but we also buy a put with the same expiration date and the same strike price. And let's say that both are at the money. It doesn't have to be that way, but it's easier to illustrate that if we bought a call and put both with the same strike price, where X is equal to S, so it's at the money because the value of the strike is the same or approximately the same as the current value of the underlying asset, the stock. We can first look at the payoff of the call. We know that if the stock price moves above the strike for the call, then that's going to be a profit. And if it doesn't, we'll walk away. It's just that we're out the premium either way. And then similarly for a put, we can walk away from it, but we only make money for a put when the spot price ends up below the strike. We get to sell for that higher strike and make a profit on the difference between the two. And either way, whether we make money or not on this put, we still have to pay a premium. So these two are our payoffs for both sides of this volatility straddle position. And if we plot what that looks like, we know that if we just look at this part right here, outside of the premium, then the call option is worthless for anything below that. But anything above this, if the stock price moves up, the call option moves up in value, linearly like that. And then if we look at the payoff for the put, again, just the gross payoff, not considering the cost of the premium, then as long as the strike, as long as the spot, the stock price ends up below the strike, then this thing will kick in and start making us money. And so these two together, combined, are kind of the weird looking payoff diagram for a volatility straddle. And this is the gross profit. You can see you make money anytime, really, whether it's up or down. Sounds pretty cool. So the one thing, of course, that we need to consider is the cost to put on this position. And that's the thing. Volatility straddles are kind of expensive because you're buying two options. You're buying a call and a put. And so if we look at the call, this time the whole thing together, the premium included, we know that we're out of the money. Even if the put expires worthless because the stock fell in value, we don't exactly get to walk away with a zero. We are lost the premium, and so there's that offsetting loss right to begin with. And that premium doesn't get recovered. Once the stock price moves above the strike, we start to recoup that premium, but we're really only making a net profit until we more than recoup our premium by an increase in the stock value. And then likewise, for the put, if the stock rises in value, the put's kind of worthless and we're out the cost of our premium. But if the stock price subsequently falls, then we start to make up for the premium, to which point beyond that, if the stock price continues to fall, this thing continues to make money. And here's the key kind of payoff diagram for a volatility straddle. Because this is how you make money. As long as the value of the stock moves outside this middle range, in red right here, then in yellow here is where you'll make money. Up or down, you'll make money as long as it moves by a large enough amount either way. Because remember, you walk away. If it goes up in value quite a bit, you don't have to suffer this loss here. And so you're really just keeping this upside. This upside is more than enough to kind of offset the cost of both options combined. And then likewise, if the stock drops by a whole ton, certainly the call is worthless, but the premium, the gain on the premium, or the gain on the put, here is more than enough to offset the cost of both premiums for the call and the put. So this is kind of a unique feature of a long volatility straddle. There's one counterpoint to this, and that's a strategy called a short straddle. And that's where you're short volatility. You're actually expecting volatility to decrease, or you're expecting the stock to stay within a certain range. Now, it's worth it to note that this involves unlimited risk. With a long straddle, you've quantified your maximum loss. You bought options. The maximum you can lose is the cost of your premium. But with a short straddle, you literally can lose an unlimited amount of money. Of course, in practice, we can put additional options into play with this strategy to cap our maximum loss. And that's something that many professional traders do. But just by itself, a short straddle, if we're just sort of replicating the inverse of a long straddle, we end up with substantially more risk. And instead of buying a call and buying a put on a stock like we would in a long straddle, with a short straddle, we still trade options that both have the same expiration date and strike price, but instead we sell both a call and a put. And that means we get to keep the premium on both sides, but we're really just selling insurance. Because if one of these positions, either the call or the put, moves against us by more than the value of the two premiums we collected combined, then that will turn this position into a loss. So the most you can gain are the premiums, and the most you can lose depends on the stock. The stock could go to zero, in which case your selling your put becomes very costly, or the stock goes very high, in which case your call is very costly. And in fact, stocks theoretically can go infinitely high, and that's really what we mean when we say unlimited risk for this position. Because we could theoretically lose an unlimited amount of money for the call option that we wrote, with only the premium that we received for both the call and the put to protect us. But not the case with a long straddle. Long straddle, we have a finite loss and unlimited upside.